Hi, everyone. Thanks for joining us. We will get started in just a minute. We're just waiting on people to continue to filter in. Okay, let's go ahead and get started. My name is Danielle, and thank you so much today for joining us on this webinar with Malden and Jenkins and Binding Sparks interest rate products. We're really happy that all of you could make it. Today we have with us Tommy Warren, Catherine Bray, and Allison Wester, and they are going to be the ones who take you through their presentation. We did want to let you know that all of the slides and the webinar recording will be available after the webinar. We will send that out via email to everyone who attended. If anyone does have any questions, please put them in the chat. And if you want to make it so that either everyone or hosts and panelists can see, that's the easiest way for us to be able to keep track of all of that. And all of the questions will be answered at the end. And Tommy, if you want to go ahead and take it away, that would be great.
Hey, thank you, Danielle, and thank you again for all of you for attending this. We appreciate the opportunity to share with you, and we're opening up the screens now. So as we start off, we've entitled this Derivatives, the Swiss Army Knife of Financial Products. So as we were getting started and coming up with this title, I thought, well, let's start by Googling what is a Swiss Army knife. I think we're all familiar with them, but I found 2 or 3 different references. One is that they are the ultimate multi-tool. A second was that it's the perfect tool to tinker your way in or out of a tricky situation. And finally, a figure of speech indicating extreme utility applicable to more or less any scenario at hand. So hopefully in the next hour or so, we're going to present to you a number of scenarios that potentially can be used and dealt with by using interest rate derivatives, and also showing just again that they are flexible and that they're not complex. So you will see next our table of contents and what we're planning to go over. I'm not going to go through that. It'll be in your slide deck when it comes to you in a few days if you want to go through that. So the first point we want to make is not assume that anyone really knows what is a derivative. So there is this idea that they are extremely complicated, hard to understand, even dangerous as we came out of the financial crisis. So Truthfully, all an interest rate derivative, especially a swap, which we'll spend most of our time discussing, it just changes the rate base of either an asset or liability from floating to fixed or fixed to floating. And that really is all it does and all it's about. It doesn't change cash flows. They aren't difficult to understand. So the traditional primary swap that we are involved with our financial institution clients are known as pay fixed swaps. And those are used to convert a fixed rate asset to a floating rate or a short term or floating rate liability to a fixed rate. And again, that is overwhelmingly what we do to the nature of a financial institution balance sheet. The first specific example we're going to talk about is commercial loan hedging. And on that, um, you make a fixed rate loan to your customer. Go back just a minute, Catherine. As you make a fixed rate loan to your customer, they're going to make a fixed payment to you. You have an interest rate swap in which you will pay fixed to your counterparty. From your perspective as the financial institution, those net to zero, and you will receive floating. So as those cash flows occur, using your counterparty in the swap, you have converted that fixed rate asset to floating. Now you can do a receive fixed in which you convert a floating rate asset to fixed rate or a fixed rate liability of floating. And we'll discuss at least one example of those as we go forward in this. So they got a bad reputation, especially in the financial crisis, and there were very complex derivatives that were involved in that, and that we heard about huge financial institutions at risk of failing. The tools that we use are very simple, vanilla derivative products that are easy to understand. Probably the best example or comparative is just an FHLB borrowing, term borrowing that you have. And if you want to get out of it, there's a mark to market that may be present in that. But other than that, you have a fixed cash flow, and the terms of the cash flows are according to the initial contract. So hopefully you'll get through that fear of derivatives that we often run into and recognize that they do have a lot of uses that are very simple to use. So why do we think now is maybe a good time to consider it? Well, as I mentioned, the big banks have been using these for years, big financial institutions. They've gone through a lot of that bleeding edge pain, and it has melded down to community banks now being able to use these products in a very easy way and be able to compete with all the products that these bigger institutions use. As I mentioned earlier, they can hedge virtually any side of the or both sides of the balance sheet, virtually any kind of rate risk that you may have. And importantly, in late 2017, FASB simplified a lot of the derivative accounting and aligned it to what we can do economically. Some of the potential transactions we're going to talk about today could have been done economically in the past, but the FASB rules just made it very difficult or impossible for the accounting to work. It was an unusual day in 2017 when the accounting world almost unanimously said FASB has helped us out and given us something that really works for us now. So again, as opposed to a lot of all of you are dealing with CECL and lease accounting, this derivative accounting was made much simpler, and the going forward of the ramifications if you had an issue were made much less draconian. So without all that introduction, let's start kicking in and going through some of the potential uses of these transactions. So the first one we're going to talk about is ways to expand our revenue is through direct loan hedging. Probably the area, if you're familiar with it, that would be the one that most financial institutions are aware of. Unless you're in a very small or limited market, you probably have lenders that are currently offering 10, 15-year fixed rate loans. It's understandable why your borrowers are looking for that. Even with the increase in rates recently, we are still at historically low rates. And just like all of us as consumers over the last few years have been refinancing into 15 and 30-year mortgages, your commercial borrowers are looking for that same kind of certainty of cash flow needs. So we have found that loan hedging allows you to compete, it allows you to meet customer demand, at the same time improve your profitability and manage your rate risk. And we think that's the key is can use these products to meet your customer needs. Ultimately, that is the key to your success on both sides of your balance sheet, that your customer needs are being met. So what are so we all, I think, would agree that in a low rate environment, it's to the borrower's advantage to lock in a long-term fixed rate loan. But what about for the bank or for the institution as the lender? Does it really work for you? And I would say that many of our customers kind of go into loan hedging holding their nose, if you will. Well, we just have to do this. It's a requirement of our competition. So I'd like to throw out a couple of ideas of why it really does help your institution too. One, we would all agree that increasing the average life of your deposits increases your core deposit franchise. We believe the same occurs on on your loan portfolio. If you increase the average life of your loans by having longer terms and economic make whole prepayment language, you increase the average life of a variable rate loan on your books, you increase your cross sell opportunities and the chances to make additional money on that relationship. One thing is, prior to working with Vining Sparks, I was a CFO of a community bank that used these products. And we were a small bank. But one of the things over time we came to learn is that with our traditional 5-year balloon, we actually were pushing interest rate risk management to our borrower. You say, how do we do that? Well, in 5 years, they're going to pay some market rate and we may build it into the original loan of what the index and rate or relationship will be, or it may just be market. But we're expecting them as a borrower to manage the rate risk if rates are up 200, 250 basis points. And just because interest rates have gone up doesn't mean that they are in a better position of being able to generate more cash flow. If they have taken on more rate risk, then you, in fact, have created more credit risk for yourself. In 5 years, their debt service coverage, their the cap rate for a new appraised value may not be there. So by extending their amortization term before a rate reset, we think that you have actually enhanced your credit risk. One more thing, and this has come to bear in the last 30 days especially, is if you're giving 30, 45-day free rate locks, we have seen how quickly rates can jump up. While you won't recognize an accounting loss, if you expected some spread over an index based on your 5-year rate and offer them 30 to 45 days before they have to close, you will not obtain that spread today if it closed and you made that lock 30 days ago. So the loan hedging, basically, generally, you are locking your loan and spread at the time of closing, so you don't have the potential of that loss of economic value because rates have jumped up on you. So let's talk about what would happen in this. We do the loan swap. We also get loan fee income. And this is something that almost all of our bank customers use. It's treated as non-interest income. It doesn't appear on your closing documents, but most of our depository institutions receive 15 to 25, maybe sometimes a little more of swap fee income. On $1 million loan, that's $16,000 to $18,000. And that is money that under GAAP, you recognize as non-interest income on the date of the loan closing. And so it is a great supplement to your margin in this time when most banks, even with rates going up recently, are still facing some margin compression in the next few months. So this is a great way to counteract it by being able to collect some of this reasonable fee income, which will maximize the life of loan earnings. So we offer three options. Overwhelmingly, we use a smart loan. The, those of you who may have done loan hedging in the past have probably done a back-to-back swap. That is the method used by the big banks. It works, it is very flexible, but it has a lot of complexity. There are a lot of documents for the customer to sign. They make 2 monthly payments, a lot of reporting requirements. This is intended to be an informational webinar, so a little bit of a commercial, but the smart loan product that we overwhelmingly use takes the economics of the back-to-back swap but makes it much simpler for your customer and for the bank. So the customer does not have to deal with an ISDA. They make one payment, one fixed rate payment to you as their lender, and we aren't really involved in the process. So I would just leave it as it's a simple way for your customer to get the fixed rate loan. You be able to recognize your additional fee income, and the accounting, which we will discuss later, is very simple. The last of the items I want to cover very quickly is something that we've been reminded of in the last, again, 30 to 60 days, or is the use of forward starting swaps. I think these are a great tool if you've made commercial construction loans and your customer is concerned about rising rates. You can commit to a fixed rate for them 1 year, 15 months, 2 years out when construction will be complete. They will know what their fixed rate loan will be, what their cash flows needs will be, and you as the lender will know what your spread is. So while there is some additional cost for doing that in this market, it's not huge, and it's a great way to assuage their fears of your borrowers that rates may change dramatically between the time of them getting the construction loan and when they have the fixed permanent loan. It also works well for the bank, and because you have entered into the swap with prepayment language, it is very difficult for them to go shop your permanent loan after you've gone through all of the uh, exercise of the construction loan and the hassles that are associated with that. So we think this truly is a great product that can be used that helps both the lender and the borrower. And we mentioned cancelable swaps. Some are concerned about prepayment language. And I'll just suffice to say that virtually any combination of allowing the swap to be cancelable at some time in the future can be negotiated with a price adjustment. So as we move from the commercial loan hedging, we're going to look at here of fixed rate mortgages. And I will go ahead and say we're using mortgages as an example. That's the typical use of a portfolio product, but it can be a portfolio of commercial loans, consumer loans, anything that has prepayment ability. So in our case study here, we're looking at an asset sensitive bank that, like many, is sitting on excess cash, has been hesitant to keep the loans that they've been maybe generating and selling because they're concerned about the interest rate risk. So what we want to do is look at ways they can add those mortgages, but hedge that interest rate risk efficiently. So we use a product called the Performance Architect, and I know you should be able to read these numbers, but what we do is at the top, you see a baseline, which is nothing but your asset liability management reports as you've reported, and it gives you both income expectations in a base case, as well as some risk metrics in different rate environments. Now, what we've shown on the screen is an up 300 basis points, but anytime we're looking at a scenario, we'll look at up and down 1, 2, 3, 400 basis points to determine the impact of a chosen scenario. Now, it doesn't take a model to tell us if we take 30-year mortgages, add them to the balance sheet, and we use our existing cash, we're going to make more money. And so we show we will add about $1 million in base one net income in the third column, just under that for adding these mortgages. But as we would expect, we do add dramatically to our earnings at risk and our EVE risk in an uprate environment. So what are some options for what we can do? This one's a little tougher to read, but it just uses the performance architect, in which we take the same information and show on option one the impact on our earnings and risk of not hedging the mortgages. And then we have chosen a couple of others, hedging with an interest rate swap or hedging with an interest rate cap. And I don't want to get too caught up in just these numbers. I think the point we'd like you to come away with is we can analytically compare different options, and we can model them here so that you have a very good expectation of what happens to you in a base case. And as you are looking and the regulators are looking, is what happens if rates go up, rates go down. And so we will model this, and then there's often not the best answer, but there is a combination of different alternatives, and you determine what works best for you. We worked with one bank recently, and actually in their case, they used a combination of options 2 and 3. They swapped part of it, bought a cap, and we could do all of that in a model and show what was going to happen in different rate scenarios, and they could pull the trigger and know what would happen if they added these and then also did different hedging transactions. Then in my last slide in this section, I want to mention just briefly how do we do that when we use a portfolio? And this is one of the new things that were added when FASB changed the rules, so that you can now hedge this portfolio using something called portfolio layer, in which you can use a combination of amortizing or bullet swaps. We would help you adjust with analytically expected prepayments, defaults, charge-offs, and come up with a scenario of which we hedge a specific portion of the portfolio. Importantly, we don't put it down when we make enter into the hedge, but we continue to monitor it, and we can easily adjust the hedge as time goes by, as prepayments may differ from what we expect. So again, this is a very efficient way if you don't want to do individual commercial hedging, or if you have consumer loans or a consumer portfolio, that you can add loans that have longer lives than you have traditionally added, turn them into floaters, and still be able to offer the products that your customer wants. So I appreciate your time on these couple of loan options. My coworker Catherine is going to take over now and walk us through some other options for using swaps.
Thank you, Tommy. Well, I wanted to take a look at the other side of these. You discussed a couple of great pay fixed interest rate swap options. So let's look at these a little differently and how we can use this capability of using interest rate derivatives to take advantage of other opportunities that may be out there. So in this instance, we have a bank with a portfolio of prime floating rate loans. The bank is asset sensitive, set up to improve as rates go up. So what can they do? They've got floating rate loans. They anticipate rates going up are going to perform better, but we'd really like to, instead of waiting for the Fed to raise rates, we'd like to go ahead and lock in some of that benefit now. So what can the bank do? Well, Tommy had shown you early on, interest rate swaps work in both directions. You can either pay or receive. In this instance, you would enter into a receive fixed interest rate swap. And depending on the term of the swap, and it's not a whole lot of difference, pick your term and the carry is almost identical. But if you are somewhere between 2 and 5 years, you're going to pick up in positive carry 183 to 190 basis points. So again, instead of waiting for my floating rate pool of loans to increase in value, why not go ahead and take advantage today, or maybe you don't think rates are going to go up quite as much as the market is saying they will today. So let's dig a little bit deeper into this. This particular institution, we're decided to enter into a 4-year receive fixed swap. The bank has about a 75 million floating rate prime portfolio. Don't want to hedge all of it. A couple of reasons. One, they just don't want to hedge all of it from a, would like to leave some of those floating. From the other side of it, really is accounting. We only want to hedge the layer that we think would still be there. Those outstanding loans that we think would be out there for the 4-year term. So right now at 3.5%, the $75 million in loans generates about 2.6 million in annual income. Well, if we take 50 million of those loans and convert them to fixed, that adds an additional $955,000 because of that positive carry. So instead of earning $2,625,000 rates where they are, you're going to earn $3,580,000. A big jump over current earnings. Now, granted, I don't think many, maybe anyone on the call anticipates prime staying at 3.5% for the next year. But maybe you don't anticipate prime going up as quickly as the market currently indicates that it will. Or maybe even if you do, you don't want to wait until nearly the end of the year or early next year for all of those increases to take place. You'd like to go ahead and enjoy the earnings now. It's why you would consider a transaction like this. And just to give you some sense, where I said rates were very similar, looking from 2 years all the way out to 10 years, these are the receive fixed swap rates. And I priced these yesterday, so these are pretty current. And you can see it's actually in that shorter part of the curve that you actually get the most carry. Actually, the 3-year as of yesterday afternoon had the most carry. I don't think many of us would recommend going out 10 years on the receive fixed, although I will say back in 2007, I wouldn't have recommended a 10-year either. And turns out that would have been the best strategy to use. Again, this is for institutions that are set up to improve as rates rise. I think it is a great way to take advantage if you think maybe the market is a bit overdone. Go ahead and take advantage of that. Or even if you don't think the market is overdone, go ahead and start generating those earnings now. Now, there are other considerations when you do these types of transactions. Obviously, you are changing your interest rate risk profile. From an accounting sense, this is something too that getting into a bit of details here, but we can't ignore how this is accounted for, and changes in market value do go through other comprehensive income. As rates go up, as term rates go up, this actually loses value. Think of it as being very similar to a bond. A bond is receive fixed, so is the swap, and would lose value. So it would exacerbate any capital at risk issues that you may have, but many don't have that, or the size of these are not such that that's a concern. But a great way, I think, to generate current earnings. Now, another way that I would say our desk has been very, very active on to generate current earnings is taking advantage of what's out there in the marketplace. And by saying taking advantage, what I always think of with derivatives is it really gives you capabilities that you don't have otherwise. And you need to have every capability, every arrow in your quiver that you possibly can. And by creating capabilities, I mean giving you the ability to, one, offer customers products that they want and desire, long-term fixed rate loans that Tommy mentioned earlier, but also giving you the ability to go out in the wholesale market, buy bonds or funding, which I don't talk about here, but this is specific to the bond portfolio. If you like a certain bond, or you like the spread that it offers, hate the interest rate risk, don't like that, well, why not buy the bond and create the interest rate risk that you desire? What I have these bubbles are, it's a graph with the gray being treasury rates. So these are just treasury yields ranging from 1 to 10 years. So here's the 1 year all the way out. You can barely see this little 10-year. So that's what's on the vertical axis. The horizontal axis was price volatility. So going from lowest price volatility out to the highest. So again, obviously the 10-year has the highest price vol with not a whole lot of yield either. So if you went out and bought treasuries, these would have been your yields. Now, what products could I go buy? And I didn't put a universe of products on here. I was very specific. And I said, you know, I really like muni spreads these days. They're offering very attractive spreads. Don't like the interest rate risk. So I have a universe of munis where I actually created the interest rate risk and price volatility that I wanted. And this range, and this is a range of 4% coupons that actually has the lowest price volatility. In other words, I've combined buying that bond with an interest rate swap, and I've actually created now a current yield of about 2.5%. So a yield that far exceeds anything else. It's higher than the longest treasury yield that's out there, or the highest treasury yield, which isn't the longest these days, but far exceeds any yield that really I can get. And from a price fall sense, this 4% coupon has about 0% price fall. If I went up to a 5% coupon, I'd actually have a little bit of negative price volatility. Now, if I wanted to get a bit more yieldy, I would buy a lower coupon bond. I've got more price volatility, but I have a little bit more yield as well. And this middle is just a blend of the two. Now, to me, I look at this chart and this looks pretty attractive. Remember, this is current yield, so where my current floating rate is, and we'll just stick with this 4% coupon that has a current yield of about 2.5%. This doesn't look too bad, looks pretty attractive. Well, remember what we expect the Fed to do over the course of this year is for short-term rates to continue to go up. Now, if short-term rates go up, I've left my treasuries where they were because I bought those yesterday, and I also entered into these floating rate munis. Rates up 100 basis points. Well, that 2.5% yielding bond is now 3.5% yield, still with the same price volatility, essentially no price volatility. So I have a bond that's yielding 3.5% with essentially no price fall, all because I created the rate basis that I wanted. There is no such thing as a floating rate muni that you can just go buy, but you can make one on your own, all because you've got a tool in your toolkit being these derivatives. And there's nothing exotic about this interest rate swap. It's very straightforward. You go out, you buy a bond that maybe is a little bit longer than what you would typically purchase. This particular one was a general market with a 10-year call and a 25-year final maturity. So long with a good bit of price volatility. You're going to combine that by entering into it's simultaneous a 10-year swap. So I'm just hedging it to the call date. The bond, I've got a taxable equivalent yield of a 462. On the swap, you paying fixed of 240 and receiving back SOFR floating. Again, this is going to reset every day. And right now, as of yesterday anyway, it was at 28 basis points. So it gives me that current yield of 2.5%. That as short-term rates are going to go up as well. So I do like this transaction if you've got cash to put to work, or as you're getting runoff in your portfolio, want to reinvest, but don't want to go out and buy those bonds with 20% price fall. Well, this is a way to buy yield without buying that price fall. Now, one of the reasons maybe you don't want to buy that price fall is because concerned about existing price volatility that's in your investment portfolio. So I would say this is probably something over the last 2 months that we have had many conversations with our clients about, and that's concerned about the unrealized losses in the AFS investment portfolio. So of course, we've all seen as balance sheets have grown, investment portfolios have gotten much larger relative to the size of the balance sheet. Many also extended out on the curve because you needed to get yield on something. So now we have this dilemma of I've got a larger investment portfolio, a little bit more price volatility, and oh no, rates are going to go up. What can I do? So we certainly, capital at risk is that metric we look at to look at the impact on book equity as rates rise. Now, there are ways you can manage that capital at risk. One of them you can manage is, of course, you can sell those bonds that have a lot of price volatility. That's, of course, the ultimate hedge. You sell the bond, you don't have the exposure anymore. Unfortunately, you do have that large loss that you're going to take. And at this point, I don't think I've seen many portfolios that don't have pretty significant losses. So that's the ultimate hedge. But what if we don't want to hedge our risk that way? Well, we can manage with swaps or caps. So we can use these same tools to, we can't get rid of losses that are already there, but we can minimize losses going forward as rates continue to rise. So let's take a look. We have a bank with about 40% of its assets in the available for sale portfolio. Book equity to assets, base case, 9.8%, so pretty typical. But up 300 basis points, it falls to below 5%. You're sitting at about 4.4% book equity. And this represents about a 27 million decline in that book equity portfolio. So again, what can we do to reduce that exposure? Of course, sell the bonds, but that loss is, you're going to realize it. You can execute a swap to effectively convert some of those bonds to floating, or purchase a cap and manage that fair value price change as well. So back to these small numbers that Tommy had shown you earlier, this one expanded out a little bit further. So hopefully what you can see, or at least get an essence of anyway, are this is this institution's base or interest rate risk profile. So this is just taken directly from their most recent asset liability reports. And key metrics that I'm looking at as I go through these examples are, first, base case net interest income. So I have taxable equivalent and nominal, and net income. So of course, every strategy that we evaluate, we're going to have to evaluate is, what does it do to our bottom line? And then for this analysis, I've looked at what happens to my key metrics as rates go up, in this case, 300 basis points. So what's my net income up 300, earnings at risk and EVE, and then that one part of our balance sheet that's marked to market, price fall, and capital at risk. And here's where you can see that loss in the bond portfolio of the 27.4 million, and our book equity to assets falling from 9.8 to 4.43%. So I want to evaluate different options to mitigate that risk. Well, first is restructure that portfolio. So really going out, restructuring, selling some of those longer high price fall bonds, going into shorter bonds. Fortunately, that does have a pretty significant cost, about $2 million to my base case net income. And it does what I wanted. My capital at risk is reduced. So my goal was to get my up 300 book equity to assets. I was trying to get to 5.5, but getting somewhere close to that 5.5%. I reached that goal of, I'm at 5.44, but obviously a very significant cost. The bank's total interest rate risk profile was okay, but was fine before. It was actually asset sensitive and set up to improve earnings at risk and EVE. Of course, more so now if I've shortened up that investment portfolio. So that was that first option of just restructuring my portfolio. Next option is, let's just leave our bonds. We don't have it. There's nothing wrong with those bonds. It's just that their yields are lower than current market. I'm just concerned that I'm going to continue to have losses on those bonds as rates go up. So I enter into an interest rate swap and effectively convert a portion of that portfolio to floating. Now, does that cost me something? Yes, fixed in the base case scenario, it will. The fixed rate is higher than the current floating rate. So in the base case, it does. If rates don't move at all, it's going to cost about $536,000 annually, but it gave me that capital at risk improvement that I was looking for. Improved capital at risk, or reduce the losses I would have in my portfolio by about $5.1 million. Lastly, I looked at purchase and interest rate cap. I know we haven't much discussed caps. Think of those as like buying insurance. You pay an upfront premium, and if the rate, in this case, I'm using SOFR, but if the rate goes above a strike rate, then I begin getting paid on it. Caps can be very much like insurance. You have a think of it as a deductible where I struck that, put that strike rate, changes what my premium is. In this case, I was trying to structure a cap that again gave me about $5 million in protection. So they all gave me the same amount of protection. In the base case, this cap actually has the lowest cost. Now I only have an up 300 scenario shown here. It doesn't provide as much benefit up 100 and 200 as the swap. So this is one snapshot. We'd obviously have to evaluate others to see if this provides the protection that you wanted. So what I wanted to show with this was you need to look at all of your options when evaluating potential ways to hedge your balance sheet. Don't just look at cash options, that we have other methods that may be more efficient. Derivatives can be a very, very efficient way to manage your risk profile. Now, flipping to the other side of the balance sheet, I did quickly want to discuss funding. Now, as just talked about, balance sheets have inflated, assets have grown. Funding hasn't been much of a topic for many over the last few months, but don't want to forget about that side of the balance sheet. We actively manage our assets. We need to make sure we actively evaluate our options on the funding side as well. So a strategy that you can use is looking at wholesale funding. And obviously you can go to the FHLB and borrow anything from short to long, or you can go to the brokered CD market and borrow long as well, or you can create the rate structure that you want by going to a funding source and then converting that maybe short-term funding into longer-term funding via an interest rate swap. In this case, I had a bank who needed $10 million in funding and evaluating different options of how they can effectively get 5-year term funding. So one option was going to the FHLB in Atlanta and borrowing from them, and fixed rate was about a 2.77%. That was one way they could do it. The other is they could borrow short from the Home Loan Bank in Atlanta and convert that to a 5-year fix via a swap. Using the swap saved about 25 basis points. So when I used the swap to convert the funding, the all-in fixed rate was 242 versus a 247. So 25 basis points we saved just by making sure we were using all of our capabilities that were available to us. Now, you do need to always evaluate your wholesale funding sources. Look at brokered CDs as well. I will say brokered CD market these days has been very, very attractive in funding yourself below treasuries. When community banks can do that, that's awfully nice to be able to fund yourself at those low levels. There are other wholesale index retail money market accounts that you can use as well. And when you're using those wholesale and indexed accounts, that's when you can use a swap if you need to change the rate basis. But you want to be efficient on that side of the balance sheet and not forget about it. And when I say don't forget about it, we are looking at different funding sources and their cost and comparing those. In this chart, I've compared just swapping that short-term advance to fixed, that's the dark line, going directly to the Home Loan Bank and borrowing fixed. I would say that's maybe the easiest way you're used to doing things, or going to the brokered CD market. And you can see actually the Home Loan Bank is more expensive than brokered CDs until we get out to about the 7-year part of the curve, and then brokered CDs get a bit more expensive. Swapping a Home Loan Bank advance to fixed is a little bit less than brokered CDs once you get out in 4 and 5 years, by far the cheapest when you get out to the long part of the curve. Now, if I had been talking to you about funding back in 2020, then what was the least expensive would have been a little bit, sometimes a little bit different story, depending on where we were on the yield curve. And we were in August of 20, we'd already kind of gotten into the COVID craziness. So it was still a little bit cheaper, but not to go brokered CDs, not as much as it is today. So just don't think because I've always funded myself one way, that's always the best way. And don't forget to sometimes go, oh, wait a minute, I need 5-year fix from a rate basis, but I don't actually have to go out and borrow 5-year. Maybe there's a way I can more efficiently do that. So with that, Tommy has given some great examples of practical ways you can use derivatives on your balance sheet. I've hopefully given a couple of other ways you can use them as well. With that, the always fun topic we're going to leave to Allison of talking about the derivative accounting.
Oh, thank you, Catherine and Tommy. I know that it is the first thing on everybody's mind is, but how do I account for this? Like, what does this look like? All these sound really great, but what does hedge accounting really look like? You know, one of the things that Tommy mentioned is that in sort of a rare relief, I guess, for all of us in financial reporting, the FASB issued ASU 2017-12 for targeted improvements in hedge accounting. Topic 815 provides the authoritative guidance within the codification if you ever have trouble sleeping or need to look up the information if you seek to add one of these transactions to your portfolio. But you know, before you determine the accounting treatment, you must first define what are your acceptable or desirable hedging relationships, which may be entirely similar to some of those we've heard about from Tommy and Catherine. You may have investments, you may have loans, you may have debt. You may be thinking about different, you know, as Catherine said, creating the interest rate risk that you want within your institution. And then you'll determine your methodology. Fair value hedges result in a recorded asset or liability with related changes running through the income statement. Cash flow hedges result in any exposure recorded through comprehensive income and recognized into income at the same time the hedge item affects the earnings. The ASU still requires that you have contemporaneous documentation of the hedge relationship at the time the relationship is established. It did not provide relief from that. You need to fully document what you're hedging, why you're hedging it at the time you establish the relationship. And then while effectiveness testing is no longer an issue, it is still required. To qualify for hedge accounting, the relationship still has to be considered highly effective. However, within the simplification in the standard, FASB realized that the concept of ineffectiveness was difficult, not only really for users to understand, readers and users of financial statements, but it was also sometimes difficult for preparers to explain. So FASB removed the requirement to record and disclose any amounts of ineffectiveness in the statements. They did revise other disclosure requirements that we'll talk about in just a minute. So they didn't totally give us disclosure relief, but they at least took out that ineffectiveness. So that being said, and go to the next slide, there's no need to really fear the accounting. The FASB standards update did more to lift the previous restrictions and complications with regard to specified benchmark interest rates or prepayment assumptions or prepayments, expected prepayments. The update expanded items eligible to be hedged to more fully allow a company flexibility with your risk management activities. And it aligned the presentation of the hedge relationship so that they are reported in the same income statement line item or consistently, as there was some disconnect with certain items would be reported in comprehensive income, but then the related interest, income, or expense will be reported in running through the income statement. So it sought to correct some of that. And as borrowers have sought to lock in low rates for longer terms, as we've talked about, these instruments have become more and more common to auditors and regulators. And so it is not something that is as unusual or exotic as it used to be. A variety of indices are available for cash flow hedges. And then fair value hedges really result in an other asset and an other liability being recorded on your balance sheet, essentially grossing up both sides. And those are marked to market monthly. I know you must be wondering, like, well, what you've talked about revised disclosure requirements. Well, what are those? The revised disclosure requirements, as I mentioned, require the presentation of the earnings impact of the hedged instrument in the same income statement line item as the hedged item. It also requires a tabular disclosure related to the cumulative basis adjustments for any fair value hedges that you had. And then it amended the tabular disclosure requirements that we already had to relate it to the effect of the income statement of the fair value and cash flow hedges. So while we did away with the ineffectiveness disclosure and calculation, we still have to disclose the effect on the income statement of these fair value and cash flow hedges. With regard to the portfolio layer method, one of the things that Catherine and Tommy talked about were, one of the updates is the concept of the last of layer method that can be used to hedge portfolios of prepayable financial assets. These portfolios were not previously available to be hedged, but because of the stringent standards, or because of the standards and the guidance. So prepayment risk is no longer incorporated into the hedge measurement because the last layer or the bottom layer is not expected to be affected by the prepayments. Then when you convert, if we want to go, just move on to the next slide, and convert floating to fixed rates, if you have borrowed, if you are looking to go that way, those cash flow hedges are marked to market with the offsetting amount flowing through accumulated comprehensive income. It does require the documentation that we've talked about before, as all hedges do, and ineffectiveness does have to be measured. However, the ineffectiveness is no longer subject to disclosure or measurement within the new standards or within the standards update. And I think, you know what, Tommy, if I wanted to get started, how do I do that? Like, what are some of my best practices?
Well, really, it's very simple, but it is a process. And we've had some people, frankly, institutions who, and I think the commercial loan hedging is one of the best examples, who say, oh, we have a good borrower and they've been offered a 10-year fixed rate loan and with the swap attached, and we want to match that, and they want to close next week. Can we do that? And our answer is, well, we can. We're ready to do it, but you have a process. Now, the good news is there's no real out-of-pocket cost, but it does take a little time where you have to understand your business need. The board and management team has to get on board. As I mentioned, I previously was a CFO as a bank, and I remember the first time we mentioned to the board that we wanted to do derivatives and interest rate swaps. I had to scrape a couple of them off the ceiling, but we were able to get through that. And then there are some policies that you'll need to put in place, some forms you will need to complete with us as your counterparty. And then especially loan hedging, there will be some training that's involved, and we take care of that with your lender's operations. But all of that's to say, yeah, generally speaking, depending on your culture and what's involved, it might be a several week to a 1 to 2 month process of going through getting your policies established, getting everyone on board with the concept of really what is no more than any other new product. Just like any other product that you want to add, this is putting another product, the Swiss Army knife, being added to your product line so that you can compete with other lenders. And with that said, I think, is there one more slide? Just our summary of hopefully you have seen that there are a number of different ways that you can use these. They are versatile. Hopefully you've seen they're not very difficult. Allison has mentioned the accounting, as she is something I am not, an accounting expert, but she sees this a lot in their business and practice. And so hopefully we've given you some different scenarios. I am confident all of these would not fit any one of you, but there may be times in the muni world, in the loan lending world, in your funding needs, that some of these may be needed either now or in the future. And so hopefully you've come away with a few different options. And when they do come up in the future, you can think about it and say, oh, I need to consider my options here of being able to offer what my customers want, or being able to invest where I want, and using these tools to control my interest rate risk. And then in our slide deck, which we will send out to you, there's some contact information for us, a little bit of information about the firms, and you should all be receiving those within the next few days. So with that, I think we still have a few minutes, not many, but a few. And I'm not seeing them, but did we have any questions that have come in?
We haven't had very many questions from the audience, but have you, with some of the change in the regulatory environment, what has been the regulatory response to a smaller institution or any institution adding these to their arsenal, their Swiss Army knife? Has there been a response?
I would say, and we mentioned this earlier, that our experience is there are very few regulators that haven't seen these already. And now I go back in my experience, and it's been a few years, but we did our first interest rate swaps when we were a 3-year-old de novo institution and less than 100 million in assets. And we continue to do loan swaps using the Smart Loan product. Every exam, we went through a discussion with our examiners. They wanted to see our documentation, our thought process of why we were doing it. But we never had an issue with it. Now, I would never be so bold as to say there will be no regulator who will not create concerns or issues. But one of the things we think we serve as a consultant, if you will, and a vendor for our financial institution clients is we are there to support you. And I'm confident we can work through regulatory questions as they come up.
I've seen it as well, with just as long as it's well documented and thought out and part of your policy, discussed at ALCO, all of those things. We do have one question that looks like it's come in. Is there a minimum loan size that can be hedged? I guess with regard to a commercial loan, what's your recommended size if you had one?
And I will take that since I talked about that area. I will give you sort of a general, and I think our general attitude is what size loan matters to you. So the size really depends on the size of the institution. And I kind of give the example of someone came into you and you're a billion-dollar institution and somebody wants a $5,000 10-year fixed rate loan, you're going to do it without thinking about it. If it's a $50 million loan, you're probably going to hesitate. So it depends on what kind of moves the needle with the size of your lending and bank. With that said, generally speaking, for a lot of our community size institutions, $1 million, $1.5 million tends to be the line that people kind of at least informally set. With that said, we have done some as small as $250,000. And so that's not a typical transaction, but it is available, and the swaps market is definitely liquid and efficient enough that you don't lose, or your borrower doesn't lose by paying up significantly by going that small. So I would say you kind of will work with you to establish the size that fits for your size institution, but literally almost any size can be efficiently hedged.
Yeah, I think that's great. And I know we're right at 3 o'clock, so we appreciate everybody tuning in. Thank you so much to Catherine and Tommy with Binding Sparks. Tommy and I have worked together off and on for a while when he was the CFO of an institution, and I just appreciate your insights and your knowledge. And please, any attendees, reach out with any questions that you may have after you've had a chance to think about some of the strategies we've talked about today. And please reach out with any questions.
Thank you.
Thank you very much. Thank